All right, so the markets had a little bit of a hiccup today. To start off the week of Thanksgiving, the holiday week. Remember, it's only a 3.5 day week this week. It's really mostly just kind of 2 days because we have a full day on Wednesday, but not a lot of movement typically, and a half day on Friday, and there's definitely not a lot of movement there. And it could be different this year. I mean, obviously today was a little bit of a difference. But I'm gonna break down, what really drove, especially at the end of the day, what really drove that weakness. We also kind of have two different markets. I'm gonna show you what they are and how they compare, and which one might win out over the course of the next week or two. So we'll break that down as well. It's also Thanksgiving week, which means it's Black Friday. Black Friday. So we have something here we want to show you really quickly. All right, so for our Black Friday sale, we have an annual sale where we offer our premium subscription. If you come up here to the top on our menu and click on pricing, you can see, click on the word pricing, it takes you to this page, and you can see our different levels of access. We offer our premium access server, which is most of our clients, about 96% of our market scholars are premium subscribers because you can see everything you get. Typically, it's a $3,000 subscription for 3 years. We offer that at 20% off, so it's $2,376, or when you average it out over the 3 years, it ends up being $66 per month. So, our monthly subscription we offer at $99 a month, just normally. So with our Black Friday sale, you actually get all of this in addition to these for $66 on average a month. It's a 3 year subscription, so it ends up being less than $2,400 for the 3 years. Again, the way you do that is you click on subscribe right there, or you can just go straight to premium right underneath pricing. That takes you to this page where you can see some testimonials here. If you scroll down, you can fill out this page. If you use PayPal, there, then PayPal does have an option where you can use PayPal credit and pay 6 months, same as cash. So no interest on a 6 month. But that's only through them, so we don't have anything to do with that. You fill this out. You either use your card right now or use your PayPal to get that 6 months, same as cash. And click on this Have a Coupon right there. And in this coupon code, type in Black Friday, just like I just did, with capital letters on the B and the F. And that will get you your 20% discount. And then hit I have read and agreed to the terms of service, which is listed up here. The terms of service under home. You can also just click on that link and then hit subscribe, and that will get you our premium service for an average of $66 per month. Or another way of looking at it, it's an average of $3.15 a day. So you get all of that for $3.15 a day, in addition to watching these market outlook videos, and that's $3.50 per market day, not even on the weekends. So let's go ahead and get started here. Today is Monday, November the 22nd, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicators. We always do. Interestingly enough, today, as bearish as today was, we got the yearly high tag today. So we actually did get a new all-time high up at 47.43 before coming back down and finishing below yesterday's low. We didn't finish below like this range of last week, so not as bad. The near-term line made a run into bullish territory, did not get into the upper reversal zone, so a little bit of a bearish high point there when you consider a relatively equal high compared to the last near-term peak, which is this last near-term run that ultimately peaked right there, that big long one that peaked right there. So a shorter near-term run now that we are back in bearish territory with a very oversold momentum line that got all the way down to the... Now, granted, last time we had a very oversold momentum line, we bounced off of that and had another good rally. So it's not necessarily the end of the world. It is a little bit long upper shadow. There is a relatively engulfing bearish candlestick pattern. It's engulfed pretty much the last three daily ranges there. When you look at the bodies of these candles. So from that perspective, relatively bearish. We're obviously not below the 23% line of this rally yet, so we haven't started an intermediate pullback. The intermediate line is still in the above the 90th percentile, so we're not anywhere close to an intermediate pullback. But relatively bearish candle nonetheless. Let's take a look at the other indexes. The Dow Jones, you got light pink shading, the yellow line. That's actually a bullish pattern, as you can see right there. So it's one of those patterns that we either bounce off of this or we keep going, right? So we don't really stay. You'll see why in here in a second too. In another pattern, we don't usually just stay here. We either bounce up or we keep going down. You can see the short-term sentiment oversold on both levels. The near-term line still above the 10th percentile. Same with the momentum line, at least today. If you look at the NASDAQ 100, it's a pretty significant bearish engulfing pattern there too, going with Fridays. Pretty rare for a Monday Thanksgiving week to be as volatile as it was. Usually it's not as volatile. Very oversold momentum line again, but the intermediate line's in the 92nd percentile, so again nowhere near a pullback. Different story for the Russell 2000. It's got the intermediate line that's actually closest to dropping out of bullish territory. It has crossed below its market sentiment line, so we get a little bit of a kind of a death cross if you look at it from that perspective. But again, light pink shade and yellow line. So this is one of those patterns where you bounce back up. The difference here is your momentum line's below the 5th percentile. So is your near-term line. That's a really bearish peak. You see that we had this near-term peak here on the breakout, right? But has since, as you can see, turned into still somewhat of a fake out. Again, I would still classify this more as a retest of that old, this old peak that we have here, kind of where my horizontal line is. So if you look over to the right, yes, we are a little bit below where my horizontal line is. But again, light pink shade and yellow line, a bullish pattern with very oversold short-term sentiment. There is an expectation we'll bounce out of this. The problem is just how bearish that oversold sentiment is. It's we haven't had both those lines down here since this day. We were in a very sideways range there, and intermediate line market sentiment was in the neutral zone for a long time. We didn't break out of that until this bullish breakout, which is the fear, right? If that's this, when we were so sideways and we get a bullish breakout coming out of that, and it turns into a fake out again, that would be more bearish than if we had just broke down out of there, because again it suckers in a lot of weak hands, and they had been waiting for the breakout at this sideways range, and then waiting for a breakout of this much larger sideways range. It sucks in a lot of new money that's trading the breakout, and then now all that new money is, as of right now, all that new money is at a loss. So that's the why fake outs can be so bearish there. So let's take a look at the Heikin-Ashi candle here. You'll notice for this week, with the S&P 500, we're not bearish. We still don't have a lower shadow, so it's not even a transition candle. Obviously, we don't have a red arrow. We don't have a negative differential down here. We don't have a falling PPO, so we don't have the indications for a intermediate pullback. And we are closing. We did get a new high. So it's, and we're not closing above last week's high, so we're not as bullish, but we're also not even neutral on here. If you look at the Russell 2000, it's a different story, right? So we don't have a red arrow, but we do have a negative differential, so which means we have a bearish candle after getting a neutral candle last week, and then no upper shadow so far. And then you can see the PPO is falling. So again, we're just a red arrow away from having what we need on this particular chart to have an intermediate pullback going. So keep that in mind. That's that kind of gives you an idea of where we're at from a broad level. Let's take a look at the 3 green arrow charts, and this is why I was telling you that we'll either bounce off of this. So we got red shading over here. We've had it for 2 days on the Dow, and this is the first day of the red arrow on the Russell. So that's 3 red arrows. So you either get, we don't have any more instances of this in the past because this was actually the pullback here, but we either stay
red, or stay or alternate from red to clear to red, and that's a pullback, or we go right back to green. Right, we go. It will take a minute, but we go right back. We only have a day or two of red. Um, if that's the case, then that's what we're looking for. That's the bullish bounce, and that happens a lot. Let's see if I can zoom out and show you an example. Yeah, so you can see you get to 1 day, and then boom, we're back up. 1 day we're back up. 1 day we're back up. Right? It's when you get, and these, remember, these were pullbacks on the Nasdaq. These when we had more than just the 1 day, and this was obviously a pullback on everything. So if we get the 1 day here on IWM, then that would be a bullish bounce signal, right? Same thing with was it the Dow that we're on. So that's the pattern that would suggest that we can really bounce off of this today. At least we're at that point where we should bounce off of this today. And if we don't, then there's the indications that we might be a little bit more bearish. As bearish as we were on the S&P, we're just a smidgen below the 8-day moving average. So that puts in some perspective just how we're still in a bullish convergence. You don't have to worry about it turning into a bearish divergence until we break the 17-day and stay below that. And you can see that's not the case. It is the case for the Dow, however. So again, if we don't bounce and come off of this, because we are now 2-3 days below the 17-day, so there's a good chance that we can fill in this gap here. To the 50, if not down to the 200, if we stay on, if we have this another intermediate pullback that quickly. For the Dow, when you look at, we are below the 23% retracement line of this run. So, by that definition, it is on intermediate decline. If you look at the Qs, of course, still above the 8-day moving average. But then you look at IWM, and like the Dow, we are 3 days below the 17 and now below the 30, and a chance to fill in this gap for this to turn into a bearish divergence. You can see the stochastics now is in bearish territory here. So it's a little bit of a two-headed monster market where your Dow and your Russell, they're kind of more cyclical areas of the market. They are showing signs of decline, of divergence, of bearish divergence, of intermediate decline. Your Nasdaq and therefore your S&P, which is very heavily influenced by the bigger weighted stocks in the Nasdaq 100, are still very, very bullish. So an interesting perspective we have. If you look at the RSI, we're still above 60, we're still close to 100. But on the Russell, we are well below minus 100, and we are well below 50. We're below 50 now, easily below 50. A stat, and the same thing with the Dow Jones, well below 100 and breaking below 50. You look at the the DMI for the S&P, still very bullish, still above 30 and below 20, below 15 on the S&P. IWM, we are not. Now we've had a bearish cross, right? The ADX is back down below 20, so we're not trending strongly to where I'd be worried about a big bearish move to the downside. But the negative indicator has come back above 20. The positive has dropped below 25. So we have ended the bullish run, according to this indicator. We've ended the bullish run on the Russell 2000. Ichimoku Cloud, still strong trend, still above the green line. Same thing with the Qs, right? Still a strong trend, well above 5, well above 80, easily above the green line. But IWM, below the blue line for a second consecutive day. Still got a gap to fill before you get to the cloud and before the red line gets below the price. But we are now, if you look at these numbers over here, which will be the current days, and look back over there at those numbers, they're both at 0. So we've ended the bullish trend according to this indicator. So that's 2 indicators now that have told us that we've ended the trend, this bullish run on the S&P, well, more, because we also have that we're below the 17-day moving average. When you look at the Bollinger Bands for SPY, it's still easily in the upper half, and we're just barely outside the upper quartile of the chart. We do have a falling bandwidth, but that's convergence mode. That's nothing. That's very normal. We're flirting with the top end of the value area. IWM, we are also flirting with the top end of the value area, but we are in the lower half of the range. We're not in the lower quartile, so we're not like that worried about it. This isn't showing intermediate decline levels yet. The Dow was in the lower quartile yesterday and is barely outside of it today, so it's a little bit more bearish, and its bandwidth is actually rising. We haven't broken below. Remember, your runs can start with a break below. When you get a break below the Bollinger Bands, we don't have a break below the bands yet, and you got a big layer of support below us. So any run that we do get, it's not going to like free fall, right? It's going to be kind of a grudge, sludge, whatever word you want to describe. It has to work its way through that volume for it to really, decline. So it's not going to be like huge declines, day after day after day, because we're not way up above this volume here. Like say, had we gone parabolic, it's actually more like where the Qs are right now. There's, you can go a little bit more to get down to this level. That can take a bigger fall because we've gone more parabolic on the Qs, but we are still in the upper quartile on the Qs of the Bollinger Bandwidth. So again, those kind of stocks, those large cap tech stocks, behaving as they typically do lately as a safety trade. Let's take a look at the intraday range. Here you can see how bearish it was. Like we got a higher high, a new 4-week high, but then we came down, filled in the gap, and got a new lower low, right? So, and closed below the prior day's low and closed right on the low. So relatively bearish there. Same thing with the Qs, right? A big engulfing outside day on the Qs. IWM also had an outside day, but not as bullish, and obviously did not get a new high, and easily in the lower half of the range now, and below yesterday's low, below last week's low, and not very much volume. Even if I were to go out 30 more days, there's a gap in volume till you get down about 227. It's another 4 points down. So there's some the path of least resistance right now for the small cap index is to continue to the downside, which would mean that we're not bouncing up off that bullish signal, and probably going to stay more bearish, and probably end up leading towards more of an intermediate decline, which again would mean that the green line gets into bearish territory, which, remember, on the Russell 2000, it almost is, right? It's already almost below 60. In fact, depending upon how bullish we are today, if we are bullish, more likely we'll get below 60 today. Now it's a question is, will it get all the way below 40 and actually be an intermediate decline? And the likelihood, based on what we're seeing on these other charts, is pretty high that we are. And now the question is, will that lead to the other areas in the market also turning into bearish decline, intermediate decline? And right now, you would say probably not, because of how bullish the Qs are, and how unlikely, how far away we are from the same patterns that we're seeing on the Russell showing up on the Nasdaq. We're still above the 8-day moving average, whereas the Russell's below its 17-day, and so it's like two different stock markets. One is still very bullish, even with a little bit of weakness yesterday. One is not bullish at all. It's not bearish, but it's not bullish either. Not bullish anymore, not as bullish as it was. So very, very two different markets. And if that other market doesn't bounce right back up here today, then we're going to be more bearish for a while in this more cyclical areas of the market, less safe haven, more associated with the risk appetite. Oh, one more chart before we finish, and that's the volatility index. So as bullish as volatility has been, and we've been very bullish in volatility in our classes here, it's still only at the 85th percentile, right? So, and we're still below 20. You don't really worry about intermediate decline until you get above 100. And so we're, again, nowhere near that. This is actually the sweet spot of bullish. When you're on a bullish trend, is being this 80. This is the middle of the bullish territory. This is the extreme lows for volatility, and you'll have some resistance up here at the 90 mark. So here in the 85 mark, you got a lot of room to run. So it's a sweet spot for when you're on bullish trends, for risk, for volatility to be down here. So what do you think? Do you agree with that technical assessment? Do you disagree? Again, the idea is, this there's strength in these large cap tech that more than likely will lead to the cyclical areas also bouncing back up too. But there is a pretty high probability that these cyclical areas are on intermediate decline already, and that could eventually lead to more weakness. We haven't seen that yet, so I think it's more likely right now that these light pink shading yellow line patterns lead to bounces in the Russell and bounces in the Dow, and bounces back up above their 17-day moving averages, and bounces eventually back above their 8, while the NASDAQ and the S&P stay bullish and stay on bullish convergence, right? Not necessarily like new bullish highs, but at least stay above the 8-day moving average while that MACD continues to converge towards 0. And then we'll either get another bullish divergence or another or a new bearish divergence. But at least in the next week or so, we're probably still in bullish convergence mode, where we just grind our way higher and stay above and use these little dips for bounces, for near-term bounces in these other areas of the market. So do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know why you're either a lot more bullish than I am, or why you're a lot more bearish than I am. All right, before we get going too far, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. Also, while you're down there, click that thumbs up icon. That tells us two things. You liked our video today. You want us to do another video again tomorrow. Comment on anything that stood out to you down at the bottom of the screen. Subscribe to our website at marketscholars.com. There's a link right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out some of these things over here on the right. If you click on the Market Outlook Live icon here, it takes you to this page, our Market Outlook page, where I review on a live basis at 3:30 Eastern Time on this page. I review the Market Outlook trades that we've done in previous Market Outlook videos, see whether we should stay in them, get out of them. I think we got out of one today. I also put on today's trade idea already before the market closed in this video. So you can check that out here, the one that you're going to hear at the end of the video. You can see all the old archives. We have over 200 archives there. So check that out. Also, if you go down below there, you can see our upcoming classes here. If you click on View More, or if you come up here at the top and click on Trading Rooms, it takes you to our calendar. You can see all of our upcoming classes. Obviously, we don't have classes during the holiday weekend, but as well as all of our previously recorded classes. We have 3 years worth of recordings there. Click on this heart icon. It opens up a new tab. Hit that like button there. Also, if you look at this thumbs up, click on that. It opens up this page, and hit that like button too. Again, the more you do that, it helps get our content out to more of our followers. That actually followers of more than 1,000 people that follow this Facebook page. But you can see it gets to more of them, the more engagements it has. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. All right, now let's break down what's driving the price action here, and let's go over here to yesterday's price action, and you can see, clear risk off, but it was really at the end of the day where it really gave us, especially on the Qs, right? The Qs were holding up pretty well. Commodities ended up holding up pretty well by the end of the day. It was risk off or risk on. Despite the dollar strength, it was risk on for most of the small cap stocks were up. It was only emerging markets that struggled with the dollar weakness, but the small cap stocks were up, the commodities were up, and then it was the big risk off sell off.
But you notice like bonds didn't rally at the end, gold didn't rally, commodities didn't drop too hard. It was just basically U.S. equities. So that, again, it kind of gives you an idea that we might bounce a little bit more today because of that, because we didn't see the same patterns. You can see a big drop in gold and bonds. Let's take a look at those charts here really quick. And there's the drop in bonds yesterday after getting a good bullish near-term high point, looking like we were coming off this engulfing pattern and dark green shading a green line. A little bit of a dip there. So we'll see if that, it's an intermediate confirmation signal. It's weak. You are bullish and you have an oversold momentum line. It's preferably to be in the green or especially above 80. So it's the weakest kind of intermediate confirmation signal you can get. So we'll see if we bounce off of that. And then if you look at gold here, that's a yellow line just like that. And you notice oversold short-term conditions. And a big gap to fill in. So we'll see how that plays out here. How that plays out here today. If you take a look at the dollar is really going parabolic right now. So keep that in mind too. And remember, the dollar right now, it's the euro that's the safe haven trade, not the dollar. The dollar is typically the safe haven trade, but that's not the case right now. Right now, the dollar is associated with commodities and risk. And so, we got up to 45 on the DMI. Like the last time we got up there was right there, and that was kind of breaking out of a bearish move. This is, we've already been in a bullish run, and we're making kind of a last leg higher. The ADX is going to be well above those highs by the time all is said and done. The negative indicator is down. See, last time we were up here, the negative indicator wasn't this low. Now it is. So a big, huge gap between the positive and negative. Very parabolic move that we have going on. If you look at the RSI and the CCI, we are definitely diverging, big time divergence on the CCI. And then again, back up above 70, which is not very common. It's very hard for the dollar, for this RSI to get up and stay up here. So, watch for the dollar start giving back some of this parabolic strength that it's had. You still got, it's got some time. It won't do it overnight and it won't crash in a single day. You're that far up above the 8-day moving average. So, and you're way up above the 30. Way up above the 30. What to the tune of 2%, which is the highest in the past year. If I were to go out 10 years, we do have that peak right there. But if I were to put a horizontal line here at that 2.5% mark, 2.15, not 2.5, 2.15, and then you can kind of see this is pretty high. There's been other times, again, when we're coming off of bearish low points, that we were this high before with the cluster, and that started a bearish run on the dollar. And here we are again, this high with a cluster. So keep that in mind, that the dollar is approaching this 62% retracement level. There's going to be some significant resistance up here as we approach into those areas. If you take a look at how the sectors performed yesterday, let's take a look, especially at the 12. Let's take a look at the comparison first. And then just look again at November the 22nd there. And then right there. All right, so you can see it was technology and communication services. It was your big QQQ names that really kind of crashed hard at the very end. They were already lagging. They crashed hard at the very end. Energy and financials, interestingly enough, were your outperformers throughout the whole day. So small cap stocks really had some, at least these sectors that are associated with small cap stocks, because these are all large cap stocks, of course. They're all S&P 500 stocks. But they're associated, they're correlated, more correlated with the small cap area because of their small weightings in the S&P 500. They did very, very well here. And if you take a look at the 12 grid for these sectors, so let's look at their 12 grid here. So here's where the weakness was. Look at that. You can see some engulfing patterns. XLC is in full-on bear mode. Energy had broken down well below its moving average. So did financials. So they're not quite. This is kind of a below moving average bounce back up. We'll see if there's any more to that. Everything else is still in bullish convergence mode. So keep that in mind when you're looking at the markets, especially kind of when you look at all the major markets that are out there. So we'll go to the 12 grid for all the biggest economies. These ETFs that track some of the bigger economies. Look at India, look at Russia, Look at the UK. Look at Brazil. I mean, we are kind of breaking hard on a lot of these areas, getting below moving averages and all the developed markets, breaking down on the big major emerging markets. It's really only the U.S. and Japan that are kind of holding steady. So, there's a significant shift in sentiment from a broad global basis. It's not really the U.S. is your outlier again, as it has been before during other global slowdowns. All right, so for our trade idea of the day, I wanted to take a look at AbbVie. AbbVie had pulled back down into, had pulled back yesterday towards the moving averages. You still have dark green shading and green line, but you had a little bit of a pullback. It's brought the short-term sentiment into bearish territory to oversold levels. So there's an opportunity here that we can bounce off these levels and maintain the strong bullish posture that we have. It's obviously got a good bullish trend going on. Whether you're looking at the weekly Hakinyashi candles, a little bit of a transition so far, but nothing significantly reversal wise there. Its Ichimoku cloud trend is still relatively strong too, above 5 and above 80, despite the drop below the green line. And your directional movement index is also still showing some relative trend strength. You're below 25 on the positive, but you're still well below 20 on the negative. So we haven't ended this bullish run yet. We still got a strong ADX there. Your RSI and your CCI are still at bullish levels, just a dip below 60, but we're still up above 50. Just a little dip below the minus 100 level, but not getting below that minus 150 area. So you have you have basically kind of a pullback pattern here down to the 17-day moving average, but still in bullish convergence, still in bullish territory on stochastics. You're still above the value area here. So we have an opportunity that we can kind of bounce off of this low point, and that's kind of the idea behind the trade for the day. We're going to sell a put at the 114 strike, the mid-30s delta, buy the 112 for protection. What that does here is it gives us about a $350 maximum reward, about 30% return on risk, a little bit more than 30% return on risk, which is what we're shooting for. If you see where my slices are, there's my break even. If I put that onto the chart, then we can come all the way down here, which by then, if we were to get down there, that's probably where your 30-day moving average will be. So you'll have a good support level there from the moving average that we can hold. There's an old low point there. If you look at it on the intraday basis here, it's way down into this area, so we'd have to start dipping into the lower half of the chart, and it would be in a significant drop mode if that were the case. And so obviously it's not the case right now, but we want to be out of it if we're dropping that far. Is kind of my point there. So remember, this is kind of that near-term decline that we're hoping that we're bouncing off of. So there's our trade. And again, if we rally up through December expiration, we don't have to worry about our earnings because we've already had that here. So we can position size for a full position size there. All right, so there's our trade idea for today, and there's our video for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Post on other people's threads. Reply to their comments. Let's keep this conversation going in between videos. As always, thank you for watching. Remember to subscribe to our YouTube channel as well as our website. Hit that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your evening and day, everybody, and we'll see you all next time.